When financial markets collapse and unemployment skyrockets, most people panic. But while ordinary investors are selling in fear, the world's smartest investors are quietly buying. They understand something crucial: recessions are not disasters, they are doorways to extraordinary wealth. This is the story of how the most successful investors turn economic crisis into life-changing opportunities, and how anyone can do the same. The mindset that separates winners from losers. The fundamental difference between those who profit during recessions and those who lose everything comes down to perspective. When the 2008 financial crisis struck, fear gripped the market. Stock prices plummeted, major banks teetered on collapse, and unemployment soared above 9%. The masses believed it was the end of capitalism itself. Meanwhile, Warren Buffett published an article in the New York Times declaring that he was buying American stocks. He wrote something that now seems prophetic: "Bad news is an investor's best friend because it lets you buy a slice of America's future at a marked down price." Buffett's crisis-era investments generated over $10 billion in profits. His investment in Goldman Sachs alone returned $3.7 billion in just 3 years. The pattern repeats throughout history. After every single recession, the economy has recovered. After the 2008 crisis, the stock market increased by over 130% in the following decade. Companies like Apple, that traded near $20 per share in 2008, went on to hit trillion-dollar valuations. Investors who understood this bought while others fled. That knowledge gap is what separates the wealthy from the struggling. Buffett wasn't alone. Hedge fund manager John Paulson made a different type of bet.
Paid back or monetized via higher rates of inflation. So paying back is very confiscatory.
He saw the housing market was fundamentally broken and shorted mortgage-backed securities before the crash came. His fund returned over 400% in 2007 and earned approximately $20 billion during the crisis. These weren't lucky guesses. They were calculated bets based on fundamental analysis and contrarian thinking. These investors looked at the same market data everyone else saw but reached completely different conclusions. They saw opportunity where others saw only catastrophe. Strategic moves successful investors make. Smart investors during recessions follow several consistent strategies. First, they focus on undervalued assets. When a company's stock price falls 70 to 80% due to panic selling rather than fundamental business problems, the smart investor sees value. Blue chip companies with strong balance sheets, consistent dividend payments, and decades of market resilience remain valuable whether times are good or bad. And Procter & Gamble perform well precisely because they provide essential products people cannot stop buying even during economic hardship. Second, successful investors practice dollar-cost averaging. Instead of trying to pick the exact bottom of the market, they invest fixed amounts at regular intervals. If markets fall another 20% next month, they buy more shares at even lower prices. If markets rise, they buy fewer shares, but they have already accumulated many at lower prices. This approach removes emotion from investing. During the Great Recession from 2008 to 2009, investors who consistently invested $1,000 monthly through dollar-cost averaging ended up with significantly more shares than those who invested lump sums at the perceived bottom. When markets recovered, those extra shares generated substantial gains. Third, they diversify across defensive sectors. Healthcare, utilities, and consumer staples prove remarkably recession-resistant because people still need medication, electricity, and food regardless of economic conditions. These sectors typically outperform others during downturns. Companies like PepsiCo and Kroger provide essential products that people consider basic needs. Their revenues remain stable even as discretionary spending collapses. Bonds, particularly government treasuries, also rise in value during recessions as investors seek safety. When fear dominates, capital flows into the safest assets available. Smart investors position themselves to benefit from this predictable behavior. Fourth, they maintain adequate cash reserves. During boom times when everyone else is fully invested, successful investors are building war chests. They keep 3 to 6 months of living expenses in emergency funds and additional capital available for investment. When the recession hits and prices collapse, they have ammunition to deploy. When opportunities appeared, he could move decisively while other investors were stuck, unable to invest because they lacked available funds. The psychology of profiting from crisis. The greatest challenge during recessions is psychological. Watching your portfolio decline by 50% triggers ancient survival instincts. Every news headline screams about falling stock prices and economic collapse. Media outlets amplify fear because fear generates engagement. The pressure to sell and move to cash becomes overwhelming. Yet selling during downturns locks in losses permanently. Those who sold their stocks in 2008 at the market's lowest point missed the entire subsequent recovery. They were emotionally traumatized out of some of the best returns in stock market history. Successful investors recognize that recessions follow a predictable pattern. They are followed by recoveries. This is not optimism. This is mathematical fact backed by over a century of stock market history. Every single recession since 1950 has eventually ended, and stocks have reached new highs. The investors who understand this emotionally are the ones who act decisively when others are paralyzed by fear. They ask themselves simple questions. Will companies like Microsoft, Coca-Cola, and Johnson & Johnson exist in 10 years? Almost certainly. Will they be profitable? Almost certainly. Therefore, are their shares worth buying at 70% discounts? Used as banks' superior financial position to acquire Bear Stearns and Washington Mutual during the 2008 crisis. These acquisitions proved enormously profitable. Demon recognized that while short-term prices had collapsed, the long-term value remained intact. He deployed capital when others could not. This is how generational wealth gets created. Not by luck, but by understanding that fear and optimism are cyclical, and those who act against the prevailing emotional direction profit immensely. Creating your own recession opportunity plan, starting immediately, even before any recession arrives, lay the groundwork for success. Build your emergency fund to 6 months of expenses. Next, accumulate available capital beyond what you need for immediate living expenses. When you have a solid financial foundation and adequate reserves, you can invest during recessions without jeopardizing your security. Set up automatic investing that continues regardless of market conditions. This removes the emotional component from decision making. Whether the market is up or down, the same amount gets invested monthly. This is your dollar cost averaging engine. Study companies you believe in for the long term. Understand their business models, competitive advantages, and financial health. During recessions, you should be buying these quality companies when fear has discounted them artificially. Focus on sectors that remain resilient: healthcare, utilities, consumer staples, and technology infrastructure. Avoid the tempting speculation and high-risk ventures. Stick to companies with proven track records of weathering economic storms. Finally, commit to a time horizon of at least 5 to 7 years. If you need the money within this time frame, recessions are not the place for it. But if you have longer, downturns become your greatest allies because you will have years to benefit from the recovery that inevitably follows. The investment elite did not become wealthy by being fearless. They became wealthy by being disciplined. They studied history, understood that recessions are temporary, and positioned themselves to buy when prices were lowest. They maintained the psychological strength to act rationally when everyone around them was acting emotionally, and they had the resources in place to move decisively when opportunity appeared. Now you understand the game. The question is whether you will play it differently than the panicking masses. The next recession will arrive eventually, as they always do. The investors who prepare now will emerge wealthier than they ever imagined. Those who panic will emerge poorer. The choice, as always, belongs to you.